Brilliant, thank you. So I'm joined by James Tom and Claire Peck. So James is from Aberdeen. He's going to be talking about Aberdeen, New India, and Claire Peck's talking about JP Morgan Asia Growth and Income. And we're discussing China and India this morning. So really, it's about trying to delve into what's been driving Asian markets and whether they can both perform at the same time, that sort of thing. But I don't want to steal your thunder. To start off with, what I'll do, if I get them to introduce themselves. So, Claire, if you want to go first, just tell us a bit about you and the fund you run, please.
Yeah, certainly. So my name's Claire Peck. I'm an investment specialist at JP Morgan Asset Management, and I've worked in the emerging markets team for the last 22 years. Um, I'm here talking today about the JP Morgan Asia Growth and Income, or JAGI as we'll call it from now on. It's a trust that allows investors to tap into the long-term growth and innovation that you get across the Asia region. And I think what's particularly exciting about it is that it invests across all countries in Asia, except for Japan. And that means you've got a really diverse opportunity set. You're investing across Korea, Taiwan, China, India, the ASEAN markets like Indonesia, Philippines, Malaysia, Singapore. So a very diverse opportunity set for the portfolio managers to pick from. And that means you've got a lot of diversity in terms of the sectors that they can invest in, but also the investment themes that are present within this region. And as a team, it is Pauline Ng and Robert Lloyd, who are both based in Singapore and Hong Kong, respectively, who manage this trust. And together they have almost 50 years of industry experience. So very well positioned both geographically and from an investment experience perspective to identify the highest conviction ideas that are coming from our research team that are based across Asia and are local to the markets that they're covering, speak the local language, understand the politics, the culture, the social kind of influences on the country, which allows you to understand some of the intangible risk factors that you face when you invest in any emerging market. So very experienced team that's on the ground looking for ideas. And this is a trust that has a very long history. It dates back to 1997. And I think perhaps last but not least, what's appealing today is that, as the name suggests, Asia Growth and Income, the trust offers a very healthy yield alongside that long-term growth. So 6% of NAV that is paid out in quarterly installments of 1.5%. So growth and income and a very interesting opportunity set to tap into.
Brilliant, thank you very much. Now over to you, James.
Yeah, hi there. So James Tom, I'm a portfolio manager with Aberdeen's Asian equities team. Obviously a Brit, but been based out in Asia, in Singapore for the last 20 years and with Aberdeen for the last 15 of those years, and responsible for managing both Asian equity portfolios, but also our India strategy, which includes the Aberdeen New India investment trust, which I manage alongside my co-manager Rita Taharamani. So that's my sort of main focus: Asia, broader Asia, and then the zeroing in on India.
And the trust?
Yeah, so the trust, well, as the name suggests, is a dedicated Indian equity investment trust. The objective is long-term capital appreciation through investing in India, but which sounds a little dry. I mean, the strapline we use is seeking world-class companies, well-governed companies at the heart of India's growth story. And I think that tells you that this is really a very bottom-up driven investment approach that we take. And we are trying to find the highest quality companies down on the ground in India, drawing on our own proprietary in-house research. We are, although not based in India, making very regular trips across the seas, not far from Singapore, into India. I think we've done 8 or 9 trips this year, to give you an idea. And that's the foundation on which we pick our stocks and find the highest quality names. And I think there are other quality managers out there. We believe that we're slightly different to some of the others. And that really comes through that point in that sort of strapline around focusing on well-governed companies. So we look at all the sort of quantitative aspects of quality that you'd expect any quality manager to look at, strong, stable growth, healthy margins, high ROC, and so on. But we also spend a heavy amount of time and focus looking at the softer qualitative aspects, and in particular kind of things like corporate governance, because it's still a market, and this is India, where you can lose your shirt. So you have to tread carefully, make sure your downside is protected while still being able to participate in the exciting upside story that is India.
Brilliant, thank you very much. Right, so let's get to it. In terms of then sort of setting the scene a bit, can you, maybe if we start, Claire, with you and talking about China, please. Tell us a bit about the sort of Chinese stock market. So how many sort of companies they've got, how concentrated is that market? What sort of benchmarks you think are the most suitable for looking at it? And is there good liquidity there, please?
Yeah, certainly. So, and one of the appealing things about China is it's a huge opportunity set. There are thousands of listed companies, both on the H-share market, which is the Hong Kong listed companies, and also the A-share market, which is the domestic mainland Chinese companies. So a very large opportunity set, but also a very liquid opportunity set. So even smaller mid-sized companies in the A-share market are extremely liquid. And that means that you can trade very easily in these companies. In terms of the concentration, you have obviously a higher degree of concentration in state-owned entities, and there are some sector concentrations towards things like financials, tech, telecommunications, and also energy. But it is a very, very large and diverse opportunity set. China is second only to the US in terms of the size of the equity market. And in most people's portfolios, given that size, both of the country and from an equity market perspective, it's very underrepresented in most people's portfolios.
And James, can you tell us the sort of same picture about India, please?
Yeah, so India is also a very large market, maybe not quite so large in terms of market capitalization as China or the US, but in terms of number of companies, there are over 8,000 listed companies in India. So it's there's tremendous choice. You can call it a sort of stock picker's dream if you like. You asked about liquidity. Again, not as liquid as China and some other markets. That liquidity does taper off outside of the, top 50 stocks quite quickly. But in a vehicle like an investment trust, you can afford and have the flexibility to take some illiquidity or liquidity risk. And so we do spend a lot of time looking at that smaller and mid-cap end of the market, and there's some great companies there. So I think it's a market that offers tremendous choice. It's a market that is evolving quite quickly. So in contrast to China, which is sort of dominated by those internet companies, tech companies, and so on, that's not yet the case outside of kind of IT services companies in India. But there are a lot of new companies coming to the market in the internet space, very dynamic, very high growth. So that's quite exciting. It means the market's kind of diversifying and becoming, both old economy and new economy. And I think my overarching kind of feeling about India is that it's just a place with, and I'm a quality manager, as I said at the outset, it's a place with really great quality companies. And so not only do you get to find companies that are growing very comfortably at double-digit rates, 20, 25% sometimes year on year, but they're also extremely well managed, investor-friendly companies that you can feel very confident investing in for the long term.
Thank you very much. Claire, one of the things that I think of when we see China is the degree of kind of state control. So the president wants to do something, everybody throws money and time and effort at it, and it gets done. How much of an influence is that on markets, and how do you factor that in when you're picking stocks?
Yeah, certainly. I mean, it's very true. China does have a very high level of state control. It is the buyer, the lender, the regulator. The Chinese authorities are all pervasive and omnipresent in the equity market. So that is something to be aware of, but I don't think it precludes you from investing in China because there is a very interesting private sector. There's a lot of entrepreneurial spirit, and there's, as we said, a very large opportunity set to tap into. There are great world-leading companies in China. The way that we manage this is firstly that you need to apply a higher equity risk premium to Chinese investments. You need to allow for that higher level of risk in your valuation and make sure you're paying the right price for the risks that you're taking. The other way that you manage it is to make sure that you have people on the ground, and we have researchers in Taipei, in Shanghai, in Hong Kong, who are meeting with the companies to understand where there are higher quality management teams, what are their vested interests, whether they're returning money to minority shareholders, and really understanding the corporate governance and the quality of the management teams, and making that assessment on whether these are the right businesses to own in the portfolio.
Brilliant, thank you. And is that also true of India, James, that the government has quite a big role in the shape of the economy and the success of some companies?
I would say it's very different to China. I mean, obviously, India is the world's largest democracy, very different political system, and there are pluses and minuses to that. I think the pluses are fairly self-evident, so that the need to place a sort of higher political risk premium is less acute in a place like India, where you've had stability and of elections and political process year on year. And it's not just the big general elections. India has 28 states, 5 or 6 of which are going to the polls every year, and some of those elections are sort of the size of the US, each time over. So a very clear sort of stable political backdrop. And policy-wise too, I mean, I would say the government is probably less omnipresent, a bit more laissez-faire. In recent sort of 10, 15 years under the Modi administrations, I wouldn't say has been sort of explicitly pro-business, but a lot of the policies and reforms that have been put in place have been supportive for the economy and supportive for India's companies. So it's I guess smoother sailing in that respect.
Brilliant, thank you. Now we are talking about the 2 most populous countries in the world, but the demographic situation is a bit different. So, Claire, do you want to sort of tell us? I mean, obviously China is now, that population growth is slowing and the population's aging. How has that factored into your stock selection and how you run the fund?
Yeah, certainly. So, I mean, this is where India clearly has the trump card in terms of the perfect textbook demographic pyramid. And China does have an aging and slowing population growth. But again, I think that can create opportunities in itself, because there are different investment themes that come out of what is required for an aging population. And you can tap into that with different opportunities in different sectors. Also, I think that the slowing growth, both of the population and the slower GDP growth that you see in China today, also reflects the fact that you don't have to have extremely high GDP growth to be an interesting investment destination, or indeed really high population growth to be an interesting investment destination. Just look at Japan, for example. So actually the fact that it is more about the quality and the sustainability of growth today in China means it's a better environment for an equity investor who's looking for equity returns, looking for better profitability from these companies. So I still think that China is an interesting investment destination, and companies are still growing at a healthy rate, and there's a lot of opportunities to tap into.
But James, India's still contending with a growing population, all the pressures that brings. Does that shape the portfolio in any way?
So the famous sort of demographic dividend does bring with it some pressures. I think that's right. Most notably, I think the need to create jobs. So India, I mean, I just love some of these stats. So I think India's producing 1.5 million engineers a year, for example. So that's great, but you've got to employ them. And actually, India needs to create probably 10 to 12 million jobs a year just to sustain its workforce and its population, given that very young demographic. So that's the challenge. But I think, so far that's been managed pretty well. The growth has been there to support that. And on balance, I would say that the demographic story is a true dividend, and is something that we do position the portfolio around. And it cuts across so many different aspects of corporate India and the sort of structural growth underpinnings of it. And again, I mean, some stats, that India has, I think, 10 million weddings a year. So we're invested in a jewelry company that makes gold jewelry. And that gold is, as we all know, sort of vitally important to the whole wedding scene in India. And so just tremendous growth for the sort of market leading jewelry business that we're invested in. The engineering talent that's ploughing into the tech sector, whether that's IT services or some of the internet companies now. I mean, India's going to remain the youngest population for the next 45 years in the world, and it's going to keep on churning out these engineers. So that's just it's going to turn India into the talent capital of the world, and that's just creating fantastic opportunities for companies and really exciting growth stories that we can invest around.
Brilliant, thank you. Now, if we think about some of the big things that have been driving markets this year globally, one of the top of the list is probably AI. So, just each of you, how are your respective countries approaching AI? Can they catch up with the United States? Do they need to do that? Are there opportunities that you can invest in? Are there challenges that this presents? Do you want to start with that, Claire, please?
So, I mean, when we think about not just China, but we think about the markets that Jaggi invests in, including Taiwan, including South Korea, these are markets that are crucial to the AI revolution. In fact, I would go so far as to say that there is no AI revolution without North Asia. Because if you look at the share of semiconductor manufacturing out of Korea, Taiwan, and also China, that is the majority of global semiconductor capacity. So very much at the forefront of the AI revolution. And I think what's particularly interesting about China, but also other parts of North Asia, is the fact that the valuations that you have to pay for the top 10 tech companies in this region are about half the valuation multiples that you have of the top 10 US tech stocks. So participating in the AI revolution, enabling the AI revolution, but a much cheaper valuation point. The other interesting thing about China is obviously that China is focused on building out its own self-sufficiency and making sure that it has national champions that can be producing semiconductor chips, that you can have software companies, hardware companies that are domestic Chinese companies. And that is an opportunity for us to be able to tap into that is quite uncorrelated to what's happening in the West. These are not linked to the Mag 7. This is China AI for China. So an uncorrelated and different take on the AI story. But overall, I would say that this tech cycle plays very much to emerging markets being the factory of the world and the picks and shovels of the tech revolution. If the last tech revolution was all about having a lot of smart engineers in a room with some laptops, that's very capital light. This tech cycle is all about data centers and all of the component parts that go into that, whether it's TSMC's advanced chips, whether it is the high bandwidth memory that you get from SK Hynix, whether it is the companies that make the liquid coolants. These are all companies that you find in North Asia, and so a lot of opportunities for us to tap into.
And you talked about all those sort of engineers coming out of India. There's you've got big software companies. Why isn't India more of a player in AI? And why is its tech sector so much smaller than China's, do you think?
Yeah, so I think so. India is definitely behind the curve versus China and the US when it comes to AI and developing large language models. I think it's a bit more like sort of liken it to Europe in a way. It sort of knows it now needs to do something. The government's beginning to invest in some model development, but there's a lot of catch up, and who knows whether either Europe or India will catch up. But there's money now being ploughed into it. There's also money being put into manufacturing schemes and incentive schemes to do some of the back end hardware. So the stuff that Claire talked about there, that Taiwan in particular is doing, Korea as well. The sort of picks and shovels element of AI. So India's trying to now take a piece of that action. The IT services sector is an interesting one. It's a large sector in India, and it's been an enormously successful sector, and one that has been able to adapt and evolve to each new wave of technology. I think the jury's out on whether they will pull the same trick off this time with AI, partly because it will create revenue generating opportunities for them, helping their clients implement AI related projects and applications, but it will also disrupt their own core operation, which is all of these talented Indian software developers and engineers who are suddenly going to find their software coding capabilities are going to get done by a machine. It's all going to be automated. So there's a question mark there. But I think for India, that maybe the most interesting aspect of this AI story is again back to that demographic dividend and the size of the population. India has about 900 million people online now. And the government has invested in what they call the India Stack, which is this public digital infrastructure, which is kind of democratizing data, all of which means that there is going to be no country in the world that is going to generate more data than India. And a lot of that data will be a sort of public utility of sorts that companies are being able to tap into, build applications, and build really interesting business models and opportunities off. So I think that's where it's going to get exciting for India. It's early days at the moment, but definitely plenty of opportunity.
Brilliant, thank you. Another big story, obviously, and the tariffs. And we had Liberation Day. We had the whole market sell-off and then the recovery. And we've had sort of some deals done, whether they're properly inked on paper or not, nobody really knows. What's been the impact on your markets? Claire, do you want to take that one first?
Yeah, well, if we go back to Liberation Day, it felt like a very dark shadow was cast over China, and there was a lot to worry about. But if you fast forward to today and the market's up around 40%, the impact seems pretty muted overall. And I think that's because, firstly, a lot was priced in already for China. Actually, this was the difference, that everybody was expecting tariffs for China, but people weren't expecting tariffs for the rest of the world. So suddenly everybody was in the same field, and the playing ground was a little bit more even. The other point is that China and the US have been divorcing one another for the last 8 years, and therefore the reliance on US exports is much lower than it was. It's a very small part of GDP, and from an equity market perspective, China is overwhelmingly domestic revenues when you look at the MSCI China breakdown of revenue location. So because China is such a large continental-sized economy with a lot of domestic drivers, actually it's more insulated than people first thought back at Liberation Day. And the headlines and the volatility around tariffs, I think, are a bit of a red herring. in our portfolio as well, we can be much more domestically orientated in our investments and stay away from companies that are more impacted by tariffs on the exporting side.
And India?
Somewhat similar, actually. So again, India is primarily a domestic story. Exports are not a big driver of GDP growth for India. So there's been a high degree of insulation, despite the very alarming kind of headlines around 50% tariffs being slapped on them, which sound terrible and frankly took everyone by surprise. We'll see if it stays there. These tariffs are still under negotiation, and I think everyone's hopeful that some sanity will prevail and we'll see a lower number. But even at 50%, in kind of fundamental terms, economists reckon it will take 40 to 80 basis points off GDP growth. So India has been growing at 7-8%. It probably goes closer to sort of 6-6.5% if that 50% prevails. And that's really because there's some big exemptions on the tariffs. So not that exports from India to the US are particularly large, but when you break it down and you look at the bigger export segments, it's things like pharmaceuticals, which are so far exempt from these tariffs. IT services, as we've talked about already, but it's a service, not a product, so there's no tariff there. So it's things like textiles, some of the electronics sector, smaller sectors that there'll be an impact, but it can be absorbed. And the Indian government is kind of taking fairly positive and assertive steps in terms of changing things like the GST tax regime and trying to stimulate the economy to offset some of this.
Brilliant, thank you. And then more recently, we've had the sort of headlines around Russian oil, and both China and India have been importing some of that. Just talk about sort of slightly bigger picture on energy generally, and sort of the shift to renewables and that sort of thing. So is China sort of coping with the climate transition, and is it much impacted by higher oil prices?
Yeah, well, China leads on clean technology, whether you're thinking about electric vehicles or you're thinking about wind or solar. China leads in that space. And China not only has its own net zero ambitions, it's supposed to reach peak emissions by 2030 and then is committed to net zero by 2060. And these are publicly stated by Xi Jinping, and therefore we assume will be firmly committed to by China. So China has its own climate transition path clearly mapped out, but China is also critical to most other countries in the world's net zero ambitions, whether that is in terms of the wind power, solar, that China is a major manufacturer of. So China is at the forefront of this clean technology, and I think that's underappreciated by a lot of people.
And in India?
Yeah, so India is a net importer of oil, and I guess that's why they've been drawing on cheap Russian oil for as long as they can. That may change. We may see the oil price, the imported oil price, have to rise a little bit off the back of that. That could impact the currency a bit, which has been weak. So maybe, it tends to depreciate most years against the US dollar, but obviously the US dollar itself is in flux at the moment. So who knows how that will play out. But much like China, India is also investing very heavily in the energy transition. It makes sense environmentally, but it also makes sense from an energy security standpoint, which is why you see both these large economies trying to do that. So there's, I think, second only to China. In fact, I think in terms of dollars being invested into renewable energy, whether particularly solar in India, but also some wind. So India's putting huge sums of money to work. In theory, that should drive some interesting investment opportunities. But so far, we've not found all that much to interest us. I think, in China, actually, that playing in the supply chain has been quite rewarding. But In India, there's less of the supply chain play. It's more investing in solar plants themselves, and the whole economics and returns of those have just not been that enticing for us.
Makes sense. Thank you. Then if you think about sort of another big sector of the economy, financials, India went through a kind of banking crisis a few years ago and has pulled back out of that. And just sort of tell us a bit about the state of play in the Indian financial sector now, please.
In India? Yeah. So you're right. India's banks overstretched themselves, lent too much into infrastructure projects. This was back in sort of 2012, 2013, and it all came home to roost in sort of 15, 16 in the form of bad debts. So it was a pretty tricky period for the banking sector. Since then, and bearing in mind that's now sort of 10 years ago almost, they have significantly strengthened the balance sheets across the board. So the state-owned banks still dominate the Indian banking sector, and there have been capital injections, capital raisings, and now the balance sheets are probably in the best shape that they've ever been in. Whether you look at sort of capitalization ratios, asset quality ratios, they all look great, which has meant that they can lend again and grow again, and they've been doing that for pretty much since the pandemic ended. So you've seen double-digit credit growth at the banking sector level as a whole, with pretty good, healthy asset quality, and that's all driving better return on equity and good returns for shareholders. So it's been an attractive sector to be invested in, and I think remains so. It's one where in the New India Investment Trust we have a pretty significant position, all in private sector banks. We're not invested in the state-owned banks, but they're delivering some great growth, and the valuations, which are always a challenge in India, in the case of when it comes to the banks, are actually still looking pretty reasonable.
And Claire, China's been through this sort of property bubble and the bursting of that, and there's been some allegations that some of the sort of local state governments have invested in things that are unprofitable, that sort of thing. So is there a financial sector problem there, or is that, how are you navigating your way through that?
I don't think there's a financial sector problem today. Undoubtedly, there are still issues within the real estate sector, and the property prices are still trying to find a floor, having been in free fall before. And that is critical to your sort of economic view for China, because not only is real estate still a large part in terms of contribution to GDP, but it is important in terms of consumer sentiment. And that's really what's been missing in China over the last few years. Because when you think about the average household balance sheet in China, most people have around 3/4 of their personal wealth tied up in property. And when you've only seen property go up in a straight line like this, when it starts to go down, that has a really serious dent on your propensity to spend, on your confidence. That's why Chinese consumer confidence has been on the floor for the last few years. Now we're starting to see that property prices stabilize, find a floor, start to bottom out. That should suggest that confidence can start to return to the consumer. You found a sort of baseline for the real estate market and a stabilization. And therefore, I think the headline for China is that the worst is behind us. And actually, you've not got a crisis. You've got a macro muddling through. And equity markets care about the trend, less about the level. And so the trend is better than it has been. You've got this macro muddling through, and that should be a better environment for people, and certainly at this valuation level.
One of the things when we talk to emerging market investors, generally they tend to be quite excited about the way that digitalization of financial services and the need to save for old age and the need to think about healthcare provision is creating whole markets, and people who've got bank accounts and never had bank accounts before, that sort of thing. Are there some fast growing financial services businesses that you're excited by within your market, Claire?
So I would say that that is absolutely the case in China, that you have, in fact, perhaps even more advanced than many other markets. When we travel to China to meet with companies, we have to rely on our Chinese colleagues to pay for everything, because you can't go around using your corporate Amex card, because everything's done via apps or via Chinese domestic payment systems and via your phone. So it's already a very digitalized sort of financial system, and there are a lot of companies that you can tap into. Some of the big names that people will be familiar with, like Alibaba, like Tencent, but there are other companies as well that you can tap into to take advantage of that opportunity.
And in India?
Yeah, I mean, I think it's one of the most exciting stories. Again, plays to the sort of demographics, the rising wealth levels. India's suddenly finding they're at that sort of interesting inflection point where India's at about just under $3,000 per capita in terms of GDP. And it's at that level, and we've seen this in places like China and elsewhere, where suddenly your sort of basic needs are covered, and you have some disposable income that you can start to kind of do interesting things with, and that includes investing in better healthcare, better, a credit card, or go buy a house with a mortgage, invest in the stock market, and so this cuts across a whole host of sectors. We're positioned around that theme in a number of ways in our portfolios, but I think one of the interesting sort of effects of this is we're seeing much more money flowing into the domestic stock market through mutual fund flows now. That it's almost like a sort of structural flow that has meant India, although India's over the last 3 years or so has been pretty much out of favor from global investors, foreign investors. Flows have been neutral to negative, and yet India's outperformed up until this year. And that's all been driven by this domestic flows, which just continues to build and build. And that's people doing two things. It's putting that disposable income into domestic mutual funds, and it's taking the decision to switch out of gold as the traditional kind of savings asset class into financial assets. And that's, I think, a structural theme that we'll see continuing, and we're positioned around in the portfolio.
That brings us neatly onto valuations, I think, because that seems to me to be one of the big differences between the two markets, is that Chinese stocks on average are a lot cheaper than Indian stocks. I know that's an average picture. Within your portfolios, what do you think in terms of where you're positioned, and do you think stocks are expensive or not, Claire? First.
Yeah, so this is where I think China has the advantage, because when you look just at a headline PE number, China trades on 13 times PE, whereas India is trading up at 23 times PE. And that's after a sort of fairly healthy reset during the course of this year. So valuations in India are demanding, they are elevated. Now, an Indian portfolio manager will always say to you, but India should trade at a higher valuation multiple because it has higher quality companies and because the return on equity is superior in India. And that is absolutely true. But India looks expensive relative to India's history. Not as expensive as it was last year and the year before, where it got out to 95th percentile on its historic valuation levels. But it's still hovering around 75th percentile expensive. So the challenge with India is it's a great story, but everybody knows it. And it's going to need a bit more time or a little bit more of a reset for valuations to be more appealing at a better entry point. Whereas in China, valuations are not demanding. Even though we've seen the market move up this year, valuations are not in expensive territory, and certainly not relative to other equity market segments like US equities, for example. So valuations are attractive. The other thing that I think is appealing is that the earnings picture is starting to look better. You're starting to see green shoots in terms of earnings revisions and positive earnings revisions in China. And from my perspective, the other appealing point about China is that the capital allocation story is improving. So the best companies in China have started to recognize that this kind of growth at any cost mentality can't carry on. Growth is structurally lower, and therefore they need to return more in the way of dividends or share buybacks to minority investors. And last year was the first time in history that China has seen negative share issuance. That means that companies bought back more shares than they issued. And that's important because historically, the issue with China was that you were always diluted as an equity investor. US companies are very good at buying back shares. It's one of the strengths of the US equity market. But in China, there was always the risk of dilution. And seeing that negative share issuance is a very encouraging sign. If we continue to see this trend and this improvement in capital allocation, more in the way being returned as dividends as well, then that will improve the return that you make as an equity investor. And when valuations are not demanding, that presents a very attractive opportunity.
And James, how do you counter the charge that India's expensive?
I think all my key points have been stolen already, or made for me, maybe I should say. But no, I think, it's interesting. So yes, the headline valuations for India are high, and it looks expensive. Although I think, when you dig into China, and I find, I invest in China through our Asia strategies, and when you find, good companies that are generating strong double-digit growth on a sustainable basis, often they're just as expensive as the Indian equivalent. So they're, China's not sort of universally cheap. Often the companies that you want to be in, you're still having to pay up for and justify on the valuation grounds. I think for India, it's a growth market, and you are paying for that growth, and you have to be comfortable that that growth is going to come through. And we have in our portfolio, many examples of companies that have grown at kind of a compound annual growth rate of 25% for the last decade. And they will continue to grow at 25% for the next decade and possibly 2 decades, because just of the wealth of opportunity, the growth potential, the demographics, all of those things, the large market size. And so it's about, I think, taking a bottom-up approach and looking at the growth and return potential of the individual companies and satisfying yourselves that you're not overpaying at the individual stock level. And that's how we approach it within the New India Trust.
Brilliant, thank you. We've covered a lot of ground. Just to sort of wrap up a bit, Claire, can you sort of maybe using a stock as an illustration within the portfolio, just describe a company that sort of sums up the Chinese opportunity for you?
Sure. So I would pick Advanced Microfabrication, or AMEC as it's known. It's an A-share company, probably a name that people aren't so familiar with. It's not a household name here in the UK. And I think that is a good example of the type of discovery and hunting new opportunities, high conviction opportunities that aren't mainstream opportunities. It's a Chinese semiconductor company, and it comes back to that point I made earlier about the fact that China will have to build up its own semiconductor ecosystem, and they will have to shift from 10% domestic procurement to 100% domestic procurement. So for a company like AMEC, that's a huge opportunity in front of them. Not trading at particularly demanding valuations, with a structural opportunity ahead of them. That's the type of company where we can see compounding solid earnings growth for a long period of time.
Brilliant, thank you. And James, same question?
Yeah, so one of our top 10 holdings is a small cap company, not in the benchmark, sort of illustrative of the depth and breadth of choice that you have in those sort of 8,000 listed companies in India. So this is a company called Aegis Logistics. And we haven't really talked about kind of infrastructure rollout and development in India. Obviously, there's a huge need. This is an example of a company that's involved in the build out of some of that infrastructure when it comes to the import of liquid propane gas, LPG gas. It's also a play on that energy transition story. So it's not renewable energy, it's not clean energy, but LPG is part of the government's sort of push and initiative to move to cleaner sources of energy. LPG can be used in a number of industrial settings. It's a cleaner fuel. It can be used in residential settings for cooking, in contrast to using wood fires, which are still extensively used in rural parts of India. So the government's got this big initiative to drive up the adoption of LPG. And this company imports that LPG into India. It's building out and developing a large network of tank terminals in partnership with Royal Vopak, the multinational company that's very successful and dominant in this sector globally, and then involved in the distribution and logistics of that LPG across the country. And it's one of those companies that's grown 25% every year for the last 10 years. And when you look and drill down into the set of opportunities in front of it, there's no reason, in my view, why it shouldn't continue to do that for the next 10 years.
Brilliant. Thank you very much indeed. Both exciting stuff. So thank you for your time today, and we'll talk to you again soon, I hope. Cheers. Bye-bye.